Hi, this is Mike Larson from Money and Markets TV. The KBW Bank Index includes 24 of the nation's largest banks. The so-called too big to fail institutions such as Citigroup, Bank of America, and JP Morgan Chase. The super regionals like US Bancorp and PNC Financial Services, and custody and trust banks, including Bank of New York Mellon and State Street. In other words, it covers a broad swath of the financial world, and it's been trading like death. From its high near 56 in February, it cratered to just over 45 on Tuesday, a decline of 19% in just 5 months. Individual banks have done even worse. Bank of America just plunged to its lowest level in 26 months after reporting a whopping $9.1 billion loss for the second quarter. Meanwhile, Goldman Sachs slumped to a level unseen since April of 2009 after it reported a 38% collapse in profit, and revenue came in $800 million below expectations. So why am I so focused on this market action? Why should you care? Because banks are the canary in the market coal mine. Look at it this way. I like Apple's products, and I own an iPhone myself. I have a LinkedIn profile, and I run Google searches all the time. But does the strong performance of these specific stocks tell me a lot about the health of the broad economy? I don't believe so. Banks, on the other hand, are at the heart of virtually every transaction on the planet. They process our credit card payments, fund our mortgages, finance our car purchases, and put up the capital for businesses to build warehouses and factories. They also execute our stock trades, manage our money, and facilitate virtually every equity or bond sale for corporate America. In short, bank earnings tell us a lot about the health of the underlying consumer and corporate sectors. And bank stocks can provide an important signal about where the broad market is heading. Just look at what happened in phase 1 of the credit crisis. As you can see from this chart, the BKX topped out in February of 2007. But the broader Dow Jones Industrial Average managed to rally for a few more months before topping out in October. Ultimately, though, the KBW Bank Index shed a stunning 85% of its value, and the Dow lost more than 54%, or nearly 8,000 points. In simple terms, anyone who ignored the message of the BKX paid a very stiff price. Now fast forward a few years, and I believe a similar process is playing out in the market today. This week, we saw a lot of euphoria over the prospects for a debt ceiling deal. Earnings from the likes of IBM and Apple only added to the positive vibe. But again, if you listen to what key financial companies are saying, you hear a much more worrisome outlook. So folks, my prescription remains the same. Exercise extreme caution in this market. Take profits off the table if you have them, lower your risk exposure, and consider inverse ETFs to protect you and profit from adverse moves in stocks, riskier bonds, and overvalued currencies. There's a message coming from the markets. Are you listening? For Money and Markets TV, I'm Mike Larson. Thanks for watching.